Hello, and welcome to the April 2025 edition of the U.S. Energy Insights. I am your host, Pamela Munger, and I'll be taking a look at the latest trends and market conditions within U.S. and global energy and sharing actionable insights powered by Vortexa's tracking analytics. In this insight, we will cover global demand indicators, OPEC versus non-OPEC crude exports, China crude imports, and structural supply to clean product markets. Now, first, let's take a look at some demand indicators that we have compiled using Vortexa data and look at it amid a market tilting towards oversupply. Now, we start by taking a look at our top import port indicator dataset. And the idea is that we have developed this within our own cargo up data for the purpose of honing in exclusively at ports where at least 90% of the imports or overall flows are imports and only 10% are exports. So the point is that we are trying to look at true domestic demand and exclude trading hubs like Rotterdam and Singapore, where is there a close link to import activity and domestic demand. And what does the data show? If you look at the left-hand side chart, gasoline has been looking weak for a long period of time. More recently, in the last couple of months, jet kero isn't looking very positive either. Negative entries and stagnation are really the main themes for motor fuels. Now, if you look at the petchems on the right-hand side chart, we see positive entries for naphtha for last year's time, and that is fitting with naphtha cracks and relative strength to motor fuels. Positive entries can be seen for naphtha over last year's time. LPG is growing, but not as fast as previous years. Now, later on in the year, there's more LPG coming online in the US, which could give naphtha more competition. Now, how does this lackluster demand picture fit in with what we are seeing on the supply picture? Now, if we look at world crude exports versus Q4 2018 baseline, Q4 2018 baseline was created because this is when the UAE and Saudi have had their highest exports. We can see non-OPEC in the purple shaded area has mainly moved sideways. However, we have witnessed a large program more recently in March, propped up by non-US America's crude exports. This movement has added to the oversupply despite the US crude exports on a softening downward trend. Total crude exports have been declining since 2023. However, we see this number returning towards mid-2024, indicated by the red line in the left-hand side chart. Onshore inventories are relatively low except for China. However, overall, there are a lot of supplies in the market. Now, taking a look at Saudi crude exports specifically, they are primed for a rise in May as planned production increases, as announced last month, have come into force to the tune of around 100,000 barrels. Meanwhile, OSPs for key grades, especially to Asia, have been set very low, and you can see this by the left-hand side chart, light blue line. The attractive discounts will likely attract spot buying and help Saudi reestablish some lost market share in China. Crude demand for power gen, along with DPP, does climb seasonally as summer approaches in Saudi Arabia, but so far this year, arrival volumes of crude and DPP at key terminals in Saudi looks slow, and this is visible on the right-hand side chart. Lower domestic demand and higher production targets, therefore, are likely to support higher exports. Now let's take a look at what's happening from the Russian crude export perspective. Considering oversupply and amid poor demand expectations, let's take a closer look at Russia. We can see a downturn in Russian Arctic crude condensate exports by grade this month, but only very recently. while overall exports are at the low end on the seasonality chart. Now, we believe this to be a structural problem with oil fields and some delays on logistical constraints due to sanctions, as opposed to compliance with OPEC+. Now, if we look at what's going on in China in terms of import levels, we can see high crude seaborne import levels coming into China that are reaching at the top of the seasonal range. Now, what is driving this? Is this real demand? This isn't likely. We do think it's underpinned largely by cheap crude and concerns over up-and-coming supply constraints under the threat of further sanctions on Iranian and Russian crude by the US. Now, this surge is likely to have a timestamp on it, as if you, especially considering the seasonality of the flows, which typically start to take a downturn at this particular time in the year, as you can see by the purple line. Now let's take a look at middle distillate exports from the wider Arabian Sea. They have been the defining element in the global product market, and it's interesting to see how much they have grown in total product liftings. This flow has placed huge downward pressure on European refiners, and when it swings toward the east of Suez, it pressures the refineries in Northeast Asia and Southeast Asia as well. Even without refineries in the region operating at full capacity, we can see the region producing at the top of the range, especially in comparison to other regions such as Northeast Asia, US, and Southeast Asia. Now, the next challenge is finding the destination outlets amid declining demand for motor fuels. Over the longer term, from 2016 onwards, OECD Asia has become more product import dependent rather than crude. Now, this is largely due to refinery closures, the inability to compete with larger refiners in Asia, and other new large Asia refineries. In general, crude imports have been low and have stayed low for more than a year, since at least 2024, while product imports have climbed since late 2024, which could be an indication of improved product demand, not just a consequence of lost refining competitiveness. Now, as we approach driving season in the US, let's take a look at what we're seeing. So if you look at the left-hand side chart, we can see that gasoline arrivals into the Atlantic Basin are on the rise. And this is largely underpinned by increased import demand by traditional markets in the Atlantic Basin, such as West Africa and the US Atlantic coast. Now, the US Atlantic coast arrivals are largely underpinned by the PADD 1 low operating rates and the continued decline in PADD 1 gasoline stocks. And lastly, we'll take a look at what's happening with TMX crude volumes. Now, Canadian crude exports out of Vancouver have reached their highest volumes in the month of March, increasing 34% month on month to 490,000 barrels per day. Chinese buying ramped up as refiners sought to diversify their suppliers, and April exports remain high. If this appetite continues with narrowing Canadian crude differentials amid upstream maintenance and Keystone Pipeline problems, this remains to be seen. Strong buying by Chinese refiners suggests that their willingness to secure these sour barrels as supply-side tightness could emerge over the summer. Now, as for exports of Canadian crude out of the US Gulf Coast, these flows have significantly reduced as Chinese buying shifted to TMX cargoes. Refineries from India and Spain continue to buy Canadian heavy sour crudes from the US Gulf Coast, but narrowing differentials for Canadian crude could possibly pressure these flows. Now, lastly, let's take a look at what's happening in terms of sanctioning vessels, especially as it relates to the Tier 1 market. So the Tier 1 market for vessels looks to be tightening due to the high requirement of non-sanctioned vessels to discharge ports. There's been at least 533 individual tankers that have been sanctioned by multiple bodies. Now, although sanctioned OFAC tankers lead the way, targeting a wide spectrum of vessel classes, especially Aframax and Suezmaxes, there's been an increased complexity and compliance risk for global charterers and traders. This overlap intensifies the pool of vessels away from the mainstream, further reducing the pool of Tier 1 ships. Now, that is all we have for you today. Thank you for watching, and we hope you will join us for the next edition of the U.S. Energy Insights.